I've seen, been shocked, do have a haircut. Did it myself to save money. It's desperate times. Just kidding. I'm a bit older now, so I figured why not give it a crack myself rather than going down to the barber, who is lovely, and I will be heading back there, but I thought I'd do it myself. I've also shaved my mustache off, which I'm a bit disappointed about, but I was drinking a soy cappuccino this morning and it was getting in my beard. It wasn't good fun. So I thought, you know what? It's time to shape up a bit, Owen. So good evening to everyone and welcome to Selfwealth Live. Normally we don't start by talking about facial hair, but why not? And tonight we're going to be talking about valuations of companies, in particular 2 tech stocks we're going to use as case studies. There is a bit of a question or a poll in the chat where you can tell us, do you think will NVIDIA, the stock price of NVIDIA, be higher or lower in 12 months? 68% have already said higher, meaning that the community is quite bullish on NVIDIA, meaning quite positive. If you did vote higher or lower, or if you just wanted to have a say, let me know what you think. Why do you think NVIDIA is such an interesting business? Like, why do you think its prospects are still so positive, even though it's been up in the charts for probably the last few years? So why do you think? Rob's just commented in the chat, asked a similar question today on Twitter. 60% reckon there's money to be made in NVIDIA. Wow. Okay. So we'll have a bit of a look at that tonight. And I'll be able to share my screen with you tonight as well. That's important because we're going to get to tonight's joke. So tonight's joke is a little bit something like this. My wife says she's leaving me because she thinks I'm too obsessed with astronomy. What planet is she on? That is my dad joke, courtesy of Dad Says Jokes on Twitter. You can check them out there or on anywhere you get your social media. Pretty good joke, not too bad. Relevant for me because I do love myself a little bit of astronomy. In fact, I do have a gigantic telescope in my other office, and it's about as tall as me, which makes it very hard to take outside, particularly in winter when you might just get a peek through the clouds. Owen's giving me a 7, Benny's giving me a 7. I'll take that, guys. Thank you very much. Didn't see the Shearer face. Okay. AI seems unstoppable, says Raymond. That's fair enough. Owen, you've said it. You think NVIDIA will be lower. It's overhyped. Radeon will throw something on the table to match it. Interesting. Martin says, NVIDIA higher due to geopolitical issues between China, USA, and Taiwan. Interesting. So you think that will be higher on account of the uncertainty? Here's a very important message from the team at Selfwealth. I'll give you just a few seconds to read through this one and see where the finger is pointing to. Once that has been digested, I will move on to the other very important message. This is actually what I looked like last week in that photo, by the way. And this is unfortunately what I look like tonight. So Selfwealth Live information warning. Selfwealth Live videos contain general financial advice only. That means the information does not take into account your needs, goals, or objectives. For example, some of you may want to own a Tesla. I don't know if that is true. If it is, let me know in the chat, but I can't take that into account if I do answer any of your questions, because you'll need to speak to a licensed financial planner before you do. I am the founder and sole director of the Rask Group. You can see we've got a company number there, which is a corporate authorized representative number 1280930 of Waddle Partners AFSL 383169. We do have a financial services guide, which is a legal document you can find on our website. The views expressed in the live streams are solely those of myself and or our guests. We don't have a guest tonight other than all of us, and do not necessarily reflect the views or opinions of Selfwealth. So we're going to do a primer on valuation tonight, and we're going to use Tesla and NVIDIA as our 2 case studies. It's going to be a very simple look at how to value these types of businesses. As some of you will know, I teach the Value Investor program, and I can say that most students do not finish that course, even though they pay for it. And one of the reasons I think, maybe it's because it's a terrible course. That's one option. But I think that the second door would reveal that investing and the science behind valuation can get quite overwhelming pretty quickly. And tonight, we're not going to do that. Tonight, we're going to talk about buying individual shares and just trying to get a sense of what the valuation at a point in time may imply. So what if you buy NVIDIA shares or Tesla shares at $269 today? What are you assuming? Like, what are you believing will happen in order for that to be a good decision. A lot of people don't know how to get to that. Is this a good decision? They tend to just go on the story, or maybe have experience with a Tesla or a friend. They were in a friend's car and the friend drove really fast and it played fart noises every time they put on their indicator or something like that. And they thought, well, this is a kind of cool car. Maybe the future of this company is quite bright. And that's not just me making a joke. You can actually turn fart noises on in your Tesla. Believe me, I've tried it and it's quite silly, but it gets a laugh. So Trough, says NVIDIA will be lower once the hype drops away. The disclaimer is fake news, says Jason. It is indeed. JJ, I'm more likely to invest in AI via ETFs, but which ones? Well, there are many popular ones, JJ. I cannot tell you, but maybe you should go and have a read of the product disclosure statements of FANG, which invests in the top stocks. We've got Semi, which is another one from Global X. Even NDQ from Beta Shares focuses on the NASDAQ 100, which I did put in my email tonight, which I think was up. I think the NDQ ETF is up 29% in a year. Let's just have a look at that. This is just in share price alone over the past year, 27% for the Beta Shares NDQ ETF, which is just the NASDAQ 100. Rob says numbers have dropped for the last few sessions because I feel a few of you are waiting on my email. Apologies about that. Yes, we are waiting for those emails to come through, Rob, but that's okay. New side hustle, the Urban Shearer. Okay, so Owen, you said the science behind value investing is intriguing, but so time consuming. I'd rather go plow it into an ETF. A friend of mine's kid turned every single sound on her Tesla to fart noises while she was shopping. Apparently, it was hilarious. G'day, Leonie. And Owen, that is true. You can actually do that. It's quite silly, but people actually do that. So, Paul, you've said, since all this talk about AI, what are some good AI stocks to keep an eye on? Well, Paul, let's get to that now. Hola, comrade CP. So, okay, let's have a look. So, NVIDIA is obviously one of these businesses. If you go to the NVIDIA website, like any US company, you can find their 10K. So a 10K is the annual report. So in Australia, we say annual report. Over there, they say 10K. So in this instance, it says it. But if you don't see the word annual or the words annual report, you're just looking for a 10K. It's how they file things over there. So if you click on that, you will be presented with a gigantic report. And we'll just get to this right here. And it looks something like this, 169 pages. But I will say one thing about the US system and the way it displays information for investors. Flat out, it is much better. So when you go into an annual report in the United States, they have to lay it out in simple language what the company does, how it sells products, what are the risks, who are the competitors effectively. They say they kind of sugarcoat a little bit. They talk about all of these things in order, and then they get to the financial statements. Whereas in Australia, our financial system reports in a way that basically shows you revenue and profit and profit per share first, and then it explains. And sometimes it doesn't even explain what the business actually does. It literally just jumps straight to like what the CEO is trying to promote or what the chair is trying to promote. Whereas in the US, these are fantastic resources. So if you do want to find out more about NVIDIA, this should be your first stop. Maybe if you didn't want to dive straight into a PDF, like maybe if you're watching this on a train or something like that, another thing you can do, which is a very good hack for anyone that wants to become an analyst, is just go NVIDIA Wiki and go to the Wikipedia page for any of the companies you're looking at. And it's a great way to get a bird's eye view of the big matters or the big factors that go into understanding a business. Like I was reading this just before, like literally in the last 10 minutes to see what would an investor understand about a company if you just spent 5 minutes reading about it. And you would understand a lot. So even if you just read this here, you get all the big picture items. You read this here, you find out how the business was started. It's really simple to wrap your head around. And then you could jump into, say, like the annual report or the 10K here and go deeper. And you can find out how they make money, what products they sell, who are the competitors, these types of things. So those hi, new host tonight. Awesome, says Chef Circle. Indeed. So Aaron, you've said yes, IFRS versus GAAP accounting. That is the correct terminology. So in the United States, they use something called GAAP, GAAP. or generally accepted accounting principles. In Australia and throughout most of the rest of the world, they use IFRS, which is the International Financial Reporting Standard. So it basically presents the same information, just in a very different way. And I personally think the annual reports in the United States, if you just read the first, say the first 30 pages of this, you will understand NVIDIA better than probably most of the shareholders that own shares in it, because they don't bother to read that. So if you do that, you'll have a pretty good understanding of the business. Because I'm not going to focus on that tonight. I'm not going to focus on what do you look for in the annual report, what do you do all that sort of stuff, because we just don't have the time. So what I'm going to focus on is actually just the businesses at large. So most of you will know NVIDIA, or most of you will know Tesla. We'll start with that. So Tesla makes cars. Pretty simple. I think it's fair to say the world's best electric cars. NVIDIA will disagree with me. They will say, where is it? I don't have the announcement in front of me. NVIDIA will say that the world's best electric cars are BYD, which are Chinese cars, because they create the software for the cars. But if you ask most people in the Western world, they'll say a Tesla is the best electric car, based on performance, range, power, features, etc. I would personally say that that's true. But so Tesla creates cars, and they're not cheap to make, hence why they are so expensive. They started with the most expensive types of Teslas to get the wealthier people effectively to subsidize the build of the company. And then now they're expanding into cheaper and cheaper and cheaper cars as they're using that initial money to invest in research and development. To put it in perspective, it's estimated that Tesla will need to spend over $100 billion in research and development before this decade is done, just to improve their battery efficiency. I think they're going for about 54% improvement, and a few other things, obviously, that they'll need to spend on, but $100 billion. So it's basically more than the entire valuation of NAB just in research and development for like batteries, basically. NVIDIA is a different company. So NVIDIA is a technology company that creates graphics processing units or graphics cards. So these are fundamentally important to artificial intelligence, because in an artificially intelligent model, you need to be able to process millions of, computations in a split second. And so what NVIDIA does is it creates graphics cards which allow that to happen. Whereas, say, a traditional CPU is more used for bigger bytes of information and crunching bigger numbers, so to speak. I'm just trying to keep it as simple as possible. Whereas a graphics card is more used for things like images and visualizations and big data sets. And these are essential in server farms and hyperscale environments. If this all sounds like gibberish, I'll get to it in a sec. Basically, NVIDIA's technology is needed to be put in the cloud so you can do all the things that you do, like use ChatGPT, put in a Google map search and find the fastest route to your restaurant tonight or something like that. That's all the type of thing that NVIDIA specializes in, as well as video games and that sort of stuff. The thing that makes NVIDIA so powerful, other than being the leader in this research and development field, to put it in perspective, in the whole life of NVIDIA, I think it's invested around $40 billion in R&D. So Tesla would need to invest double that in the next 6 years versus NVIDIA, which has done that in, say, like 20 or 30 years. So the thing that makes NVIDIA so powerful is that it combines the hardware, so the graphics cards. I'll see if I can get an image up of a graphics card. I don't know if this is going to work. Graphics card. The thing that makes NVIDIA so powerful is software engineers can plug in to the NVIDIA platform and make use of its computing power without having to build their own. So in effect, what you have is basically like an on-demand artificial intelligence platform. So almost as if you don't need to build it, you can use it, and you pay a fee for that. And so it's built these two products effectively, where it builds like all the graphics cards, but then and designs them, but it also allows you just to plug straight into the platform if you just want the software. And that's what has made this business so powerful, and why people believe it is kind of like the future, because You can just plug into it from anywhere. So you can go through the reports and learn more about it. They do use a bit of jargon. I used a bit of jargon before called hyperscaling. That's just basically a cloud, like a cloud environment where the servers are stored. And hyperscalers are like Amazon, Microsoft, Google, etc. Okay, so now that we've got a basic understanding of what they do, we know NVIDIA sells software and graphics cards, and we know that Tesla sells cars and software to go along with that. You can see if you jump into Tesla's 10K, you can see the revenues, and I'll just zoom in a little bit here. You can see Tesla's making most of its money by selling the cars, not so much by leasing or selling its credits that it gets, like carbon credits. It's actually just selling cars, more and more cars each and every year. And if you do a bit of a Google, you can just search for number of Tesla vehicles produced by year or by month, or in this case by quarter. So we can see that Tesla's producing 440,000 Teslas every quarter, and that has grown rapidly since 2016 when it was doing 15,000. So that is one of the reasons why its share price has gone absolutely bananas. So Leonie, you've said, I just got an email and it's already started. Oh, you just got an email about the live show. That's a shame. But glad you got it. I'm sorry it took so long. Benny, you've said you think Toyota are bringing out a solid state battery by 2026. Yeah, I think it's a lot of the companies have promised this, right, Benny? A lot of the companies have promised variations. They're what we call electrifying their vehicle fleet. So and that's all going to take place this decade. Like Ford's announced it. BMW's already doing it. Kia, Toyota, they're all doing it. And by the end of this decade, it's almost like the majority of cars, it would seem, are going to be, or at least majority of cars sold in the Western world will probably be electric. When I say probably, the current estimate is 30% or thereabouts. But that's up from 3% in 2020. But by and large, most people should be buying electric cars from here on out. If they're upgrading to a new car, et cetera, et cetera. A lot of people you've probably come across in your friends or family network have said that, would say things like, oh, I think it'll be the next car that I get, the next car that I get. But when push comes to shove, I believe a lot of people who are purchasing brand new cars will be purchasing electric cars because it would make so much more sense. For example, where's my phone? I don't have my phone on me. I would show you that, for example, to fill up my Tesla this morning, I think it was $20. And that gets me about 450 Ks in the car. And I drive a bit of a hoon. So it gives you a sense of, in many of the cases, Tesla's already comparable to an to a combustion engine, but the performance is better and it's cheaper. So a lot of people will start to realize that, as well as the government incentives that are coming down the pike. Okay, so CP, you've said, just real quickly, you've said Tesla needs to spend increasing dollars to retain its moat. The electric vehicle car space is getting exponentially competitive with good and cheaper cars. Absolutely. So one way we can do that, CP, is we can compare the number of cars produced, which is that's shown on that screen just there, the number of cars produced against the cost of goods sold. So we could effectively add up the last year of the number of cars that Tesla has produced. Then we jump into the Tesla annual report, and we would look at this cost of revenues, cost of automotive sales, and you basically just compare those two. So you compare the number of cars, or you divide this by the number of cars sold, which tells you what it costs. And the cost of a car is Tesla's number one focus right now, to your point, CP, because if they can bring down the cost of a car, then they can offer it for a lower price, right? Which means that it actually would make it almost impossible for Toyota, for insert company, competitor, to compete not just on performance. Like, they could probably compete on performance, but the car might cost $1 million, but they can't compete on performance and cost. So that's where Tesla's trying to take its next competitive advantage. It's already got the competitive advantage in charging, in batteries, and all that sort of stuff. But now they're trying to take it into a cost advantage as well, which means they have to spend $100 billion to invest in that R&D. The problem that happens is that you're right. They have to, I agree with you. I mean, I don't know if either of us are right. I shouldn't say that, but I agree with you that I believe that they have to increasingly spend more money. But I actually think that Teslas would have to be 5 years plus ahead of the competition in terms of the technology. So all this is to say that no company has it, and this is one thing that probably a lot of new investors miss, is that no, I don't believe that any company actually has an infinite competitive advantage. There is a time when whatever you do, whatever you sell, whatever you have will be replicated or offered by someone else. Even if it's a patent, it expires. The only times that you don't see that is typically in monopolies. So that's why they're kind of like outlawed in the Western world, where a government basically says you are the sole company that has the right to sell this product in this country, and they're very rare for that reason, because they can make exponential profits for really no effort, no innovation. But having competition is actually good. And a good example of this is just look at Amazon. Jeff Bezos said something quite a few years ago on Bloomberg when he was interviewed. He said that I believe that we are 2 or 3 years ahead of the competition. This was early days for AWS. And Google had just been launched, and GCP had just been launched, and Microsoft Azure was already a big player. And he said, what we are producing now, all the others will be producing within 2 years. So our only advantage, even though this is a very technically difficult thing to do, our only advantage is time. We are first. And so that's basically what's happening with, I believe, with Tesla. Aaron, you said, is the enterprise value still more than the rest of the world's car companies combined? It was a couple of years ago. That's something we can have a look at in a sec, Aaron. I read last week that Tesla just licensed their charging network to many other car manufacturers. That's right, Paul. So in the United States, some of the car companies and the car companies that you know as like the world leaders, they've given up. And they've basically said, well, we're just going to let Tesla do it. And we're just going to use Tesla's chargers. And I can tell you that, I'm sure anyone in the chat that has one of these could tell you that a Tesla charger can charge 40 or 50 or 60 times faster than any other charger. So you'd be crazy to go anywhere else. Okay, so let's jump into it. So what I've done is I've got some numbers, just some very high level numbers from Ticker. This is that costs about $20 a month. We've spoken about it before. It has data on ASX, US companies, and it was that thing that you could use to screen for companies. But I was just chatting to Rob off air as well, and you can actually get what you need without using that subscription. So if you jump in here in the Selfwealth portal, you go into the financials tab, and you can see revenues here, and you can see the number of shares outstanding, which we'll need in a second. I'll get to that. You can see net income. So let's just define these terms. Net income just means profit, guys. In the United States, they say net income. In Australia, we say net profit. That's what's left to you as the shareholders. The shares outstanding, which is this thing down here, is the total number of shares that are available in the company. So there's 3.47 billion here in, is this Tesla's case? Yeah, Tesla's case. You can see the revenue, which could also be called sales, is $81 billion in the most recent year. And you can see how this has grown. If we take that off real quick, you can actually see here how exponentially, speaking of exponentially impressive this has been. It's grown wickedly fast. And the same could be said of NVIDIA, by the way, guys. So NVIDIA has much the same kind of effect. It's actually growing a lot faster than this, and it's expected to grow a lot faster than this. So just based on this income statement, which is the same thing that you would find if you went in, I'll go to the zoomed in version. If you go here and you go to financial statements, so item 8, if you go here, scroll down, if you go to here, this is the same stuff you'll find here. So you've got revenue, you've got some expenses, you've got net income or profit, you've got profit per share, net income per share, profit per share. I always use the diluted version. I can explain why soon, and you can see the number of shares. So I'll just quickly define what diluted means. When a company compares its profit per share, it has a choice to compare it just based on the number of shares that are available to be traded. That's called basic. Or it would include all of the shares and options. So like the stock options for employees and etc. So that's called diluted. If they quote basic, they have to quote diluted to give you a sense of how many options are available. And you'll see that that's always lower because there's always a small number of options that are available to employees or to the CEO or whatever. The final thing down the bottom here is you can see the number of shares that they've used to compute their profit per share. You'll see it again here. The reason we call it weighted, I'll explain that why in a minute, but we call it weighted shares outstanding or weighted shares used. This just means that some of the shares weren't there the whole year. For example, imagine a company that has one share for all of the days except for the last day, June 30th. They then create another share. Well, then the weighted average number of shares for the full year would be more than one. It would be just over one. But the next year, it would be more than two or two. I hope that makes sense. Okay, so what I've done is saved us a bit of time, and I've copied some of the sales data and the profit data and the number of shares from out of those things. So out of here, out of Ticket Terminal, you could do it from Selfwealth, you could do it from the actual reports. If we were doing a full valuation model from scratch, like if I was sitting down with you, I would get it directly from the reports. I wouldn't get it from any other source, frankly, because when it comes to investing my money, I like to trust the original source and the original source alone. So, but because we're just keeping it simple tonight, I'll show you. So we've got in the gray shaded area, we've got financial years. And now what I'll do is I'll just get rid of some of this formatting because it looks kind of ugly. So what we can see here is we've got the gray shaded area. This is what's already happened. This is like factually correct. So as in it's been audited. So as best as we know, it's pretty correct. And what we can see in the yellow are the estimates of analysts. So this is like analysts like say myself or from like one of the big investment banks in the United States, like JP Morgan or UBS or whoever you've seen on Wolf of Wall Street or The Big Short or in the newspaper. They make estimates based on what they think the company will be capable of in the future. So let's just do a really quick thing. Like let's say they sold $81 billion of cars in the 2023 financial year. If they were hypothetically $100,000 each, we could divide the number of we could divide the revenue by the price of cars to see how many they have made. This would be more like this, I believe. I'm just going to test this. Yeah, so we could see the number of cars that they've manufactured. And you could do the same thing to figure out how much they cost. You could just take the costs from the income statement and divide it by the number of cars to see the average price. Okay, so we've got the sales, we've got the revenue. It's pretty straightforward here. We can see that they've got a profit down here, and we can see what analysts are forecasting in here. Now, what this would mean is if we just add another row and we divided the net income or profit by the revenue, as a percentage, it means that we're assuming that the profit margin of Tesla is 15%, right? It's gone up from 2.3 to 10 to 15. If we just take analyst consensus forward, so we just take the analyst numbers and we see what they're effectively forecasting, we can see that they think that the profit margin will kind of remain steady for the future. So we can see that there. And this would be also evident inside the Selfwealth platform. If we go to things like ratios and we go down to margins and we can see net profit margins and these types of things, right? So we can see them there. Net profit margin 5-year average, it says here, this is for NVIDIA, is 27% or thereabouts. So we could do the same thing for NVIDIA if we just insert a row below and we go just like this. We'll turn it into a percentage. Just like this, we can see what the average profit margin has been. So here we can see that analysts are forecasting something that is very positive, and you can see it jumps in the years ahead. And there's a few reasons for this. I'll get to that in just a sec. Well, as you can see with Tesla, they're being a little bit more conservative, although they are forecasting a big increase in sales. Okay, so far, so good. Why would we think that? Does anyone want to guess? Feel free to chuck this in the chat. Why you think the profit margin of NVIDIA is higher than, say, it would be for Tesla? So why would NVIDIA have a better, like a wider profit margin? It makes more profit for every dollar of revenue that it says. If someone wants to just chuck that in the chat, I'll just play some hold music and have a glass of my water here. let me know, and I'll come right back to it. And while you do that, I'll just scroll. Look like I'm busy doing something when I'm not really. Still haven't seen anything in the chat. I think I'm about 3 or 4 seconds ahead of you guys. So it seems we don't have any takers. But I can tell you the answer, given that there is a delay. Reduce costs, says Plant One. Good one, Plant One. So the reason why NVIDIA's profit margins would be better than Tesla is just as a very high level thing. CP, less competition, that's a good one. I always get this wrong. PDB, I always get the wrong way around. NVIDIA has a huge edge on AI platform. Lower CapEx. That's right. So Tarwin, you've got it in one. So cars versus chips as trough. Yeah, that's correct. So in this instance, Tesla's selling cars, right? And cars need to be manufactured. For NVIDIA, they don't need to manufacture anywhere near as much. They can outsource that and they can sell software if they want to. And we know that software is a really good business to be in because every time you sign up for Netflix, the CEO of Netflix back in America, they don't know if you've signed up. They don't know if the next house is signed up. You just pay them extra money and they still make the decisions that they were going to make anyway. And that's so what that means is like for every extra person that uses Netflix, it doesn't really change the cost. And that's what we call scale. We can see that on display with NVIDIA. We can't see that as much with Tesla. And that's probably because in the future, like I said before, it's expected it's going to need to spend $100 billion to improve its cars and its batteries. And so that impacts the profit. If you're spending $100 billion, it's going to impact your profitability. So yeah, cost much less to make. Yep, Vigis, you got it correct as well. Wonderful. Okay, so now let's have a quick look. So far we know the profit margin, right? I'll just split that out, put a little bit of a formatting around that. So now we know the profit margin. If I was an analyst, I'd indent it and put it something like this, and I'd express it like that. Vinay, you've just come up with something which I was going to get to in a few minutes, but that's good. So Vinay, you've said on the flip side, Tesla has the self-driving software, which is way ahead than the rest of the other companies. Yeah, it is. So Tesla's self-driving is, yeah, as far as I can tell, the most advanced. Okay, so we've got the profit margin so far of both Tesla and of NVIDIA, right? I should probably do the same thing for both. As when I train people to be analysts, I always say that I'm a bit of a stickler, and people will know this, for formatting. Everything's got to be formatted correctly, because when you're an investor and you go back into your model and you've got 50 of these things, you want it to be consistent so you know where to go to find the information. It's like in your tool shed. If you just got stuff chucked in everywhere, you'll never be able to find the hammer. And you'll probably just end up buying 5 of them. So Bunnings will thank you for that, by the way, though. So here we can see we've got our 2 models already looking pretty crisp. So what a lot of these companies do in the US, I'm just going to get rid of that, and I'm just going to save it right here. Not that one, Owen. I'm going to save it right here. I'm just going to get rid of that. Okay, so basically what we know from these 2 companies is that both of them are growing incredibly fast. But one thing we should check if we jump into Selfwealth or wherever you get your data, we can just have a look at the dividends, if they pay a dividend, if they don't pay a dividend, right? We can see that there's a 16 cents dividend here for NVIDIA, which equates to a dividend yield, hold on to your hats, Shirley, of 0.04%. So most of us will probably not be waking up every morning thinking that, oh, I'm going to go buy some NVIDIA shares for the dividend yield. You just wouldn't do that. Let's have a look at Tesla. So for Tesla, there is no dividend and there's no dividend yield, which would make sense. So you're not going to buy either of these 2 companies for dividends, right? Maybe in the future, but not right now. So what that basically means is, right, that most people who value these companies are valuing them for growth. They're not valuing them for dividends, at least not right now, maybe in the future, right? So we've got to kind of have a tool that values these companies for growth. Fortunately, that's what we're here for tonight. Okay, so we know that we've just used the analyst's forecast for the future. let's have a look at what analysts are effectively pricing in for revenue. So I'll go like, actually, I'll just copy this formatting. Just go like this. I'll just go like this and like this. Okay, let's have a look what the company has done historically. This is revenue. I should have just written it out. Revenue growth, right? Let's have a look at what the company has done historically. Let's go like this. Like this. I have to -1. Good maths. So drag left to right. Let's put a percentage on that. So here we can see that Tesla has grown some years at 82%, 14%, 28%. So it's growing fast. This is what I'd characterize as fast growth, right? Let's do the same thing for NVIDIA like this, and we can check the formula, and we can see if we just use some conditional formatting, something like this, and we'll go something like this. We can have a look and we can see the periods where it's grown really fast in percentage terms. Conditional formatting, let's just have a quick look, something like this. Again, we can see based on our assumptions what the company is going to do in the future over here and what it's done in the past. Now, if we look at the average revenue growth rate, and this is all going to make sense in the next 10 minutes, don't you worry about this. And you'll be able to see how a valuation is done. So if we go to the ratios tab back inside Selfwealth and we scroll down to, I don't think it's actually managed, it's growth rates. So if we click on this, we can see the revenue growth rate, like this is the annual growth rate of 47%. That's the average, right? So you don't even need to do the calculation yourself. You can see it there, 47% for Tesla. Let's go to NVIDIA. And let's get the same thing up down here for growth rates. We can see 22%. So Tesla's growing faster, right? So far, so good. Okay. Okay, so far we can see that the companies are growing both wickedly fast. We can see the profit margins, so we know how profitable they are and where we think they're going or where analysts think they're going. So all we need to do now is one final thing to figure out is the number of shares that are available in the company. So we can see historically that the number of shares for Tesla have gone up. It's gone up from 2.1 billion shares available to 3.47 billion shares available. And basically what this is telling you is, in effect, has the company issued or sold more shares to fund its business? And you can see in the case of Tesla, it has had to sell some shares to grow its business. We can see in the case of NVIDIA, it's not so much the case. Because if we took this and put it in a chart, it's a really simple chart, we can see the number of shares are basically flat or declining. So what that means is the company's doing a buyback of shares. Now, this is where it gets interesting, right? Okay, so we know the number of shares for Tesla have gone up pretty quick. So we could probably assume some sort of growth in the future. However, Tesla have said that if they get to a position where they don't need to invest so much money, they'll probably start to buy back some shares. So let's just assume that that continues at the same rate. So they're not going to issue that many shares. Let's just make that a different color. And now what we can do is we can work out the profit per share. So I'll just make this profit per share to make it easier to understand. And the way you do this is you just take the profit that you have assumed up top and divide it by the number of shares. And we'll copy that formula to the right. So now we can see the amount of profit per share. And you can probably see where I'm going with this. We'll do the same thing for NVIDIA. We'll just get rid of that and we'll make sure it all calculates correctly. And we can see, again, the number, like this, the amount, of profit per share. So according to the analysts, which is all of these numbers here, which with the exception of this one, which was our one, you can see that the profit per share of NVIDIA is estimated to go way up. Okay, so now you're thinking, okay, Owen, you've given us all this information. How does this actually make sense? The most common way that people value shares in growth companies, like when we talk about them, at least, it's not so much with analysts, it's more like individual investors who maybe are newer to investing. What they'll do is they'll look at a company's price earnings ratio. And the price earnings ratio simply compares the total value of the company or the market cap against its earnings or its profit per share. So the top one is the price, the share price, and the bottom one is the earnings per share. Now we have the earnings per share, so we know that. We can see that here. We've got the earnings per share. We know the share price because I've pulled the share price in here into the Google sheet. It's $269 for Tesla and it's $424 for NVIDIA. So let's have a quick look at this. All right, we got it. That's right. So if we know that most investors value a company based on its price earnings ratio, couldn't we say that in the future, if we guess what the price earnings ratio is, we can guess what the share price will be? So you probably see where I'm going with this. So if we know that in, say, I don't know, 2025, financial year 2025, Tesla's got $6.39 of profit per share. If we just said that investors if that company had a price earnings ratio of 20, couldn't we just multiply that by 20 and that would give us the implied share price? Now you notice that I've already done that for us down here. I've taken the estimate of the profit and I've applied a price earnings ratio. So I hope you're all, if you have any questions, please send them in now because this is where we get to the juicy stuff. So effectively, what we're saying is we know the profit in the future because we've made these assumptions. Now we've got what we believe another investor in the future will pay for those shares. So after 5 years, we say in this instance, someone will pay us the equivalent of 50 times the profit per share, which would mean the share price of 354. In 2028, someone would pay us the equivalent of 30 times, which would be the $212 a share. And then we can compare this to the current share price to determine, does it look like it's good value or does it not look like it's good value? So you can probably see where this is going. Now we can do the same thing with NVIDIA, right? We can effectively, this is not correct. So we can take the earnings in the future like this, and we can multiply it by that. Just lock that on there. And we can get an implied share price. So here we can see for NVIDIA, if the company achieves this by year 2028, and someone would pay us 50 times the profit, the share price would be $952. Plant one, you've asked jokingly, is this Mike Kemp approved? I don't know. As you know, I spoke to Mike recently, and he's a wonderful investor, one of the best I've ever come across. And he likes to keep things really simple in the way that he thinks. I think you might remember from that Plant One, Mike spoke about the reason that he bought Collins Foods shares. For those of you that don't know what Collins Foods is, Collins Foods is this company on the ASX, and he bought it not long after the IPO. He bought the shares because he calculated that the value of the entire company, the market cap, and the number of franchises that KFC had meant that you could buy the company's shares for less than the value of starting your own KFC franchise. And he thought, that's pretty good value. Tim, you said, can you do this for Square? If we have time in about 5 or so minutes, Tim, I'll give it a crack. But you could do it too, by the way. It's pretty straightforward. So let's now do some work. Okay, so we've got this very simple model. Oh, one thing based on Plant One's comment, which is actually fair. A lot of the great investors who I know use this model to value shares. They do not use the other variation, which is the one that I teach as part of the course. They do not use this. So they do not use a full discounted cash flow analysis. They do not do this and go for days and days and days. They instead just use this, a super simple model. So if you think that valuation has to be this mystical thing that only the people with PhDs have to calculate, I think you'd be mistaken. If you want to go and get a job at one of those mystical places, of course, you'd probably need to know that stuff. But for the most part, this is what a lot of professional investors use. Gaurav Sodhi told us this the other day, that he uses this type of model, this exact type of model for Lavisa. So that's that, the retail store. My good friend Andrew Page uses this model for all of the small caps that he values. And in fact, a lot of my peers who would buy private businesses might not use earnings per share, but they might use sales or something like this. Paul, you said, gotta love KISS, keep it simple, stupid. Funny you said that, because I'm going to jump straight to the quote for tonight. So any attempt to value businesses with precision will yield values that are precisely inaccurate. In other words, it's better to be generally correct than precisely wrong in investing. And I think the investors who keep it simple and focus on the business, not the modeling, will be better longer term. Okay. Now, Seth Klarman's book. If any of you have a copy of Seth Klarman's book, I'll give you $50 for it, and you can send it to me. You'll find my information on Twitter. I'll give you $50 if you've got an official copy of Seth's book. Thank you very much. I won't tell you why I would pay you $50 for that book, but there it is. Okay, so if you've got that laying around at home, I'll give you $50. So anyway, let's come back to this. So now we know we've got this super powerful tool of how to value basically any share. You can use this, but it does require a few tweaks if you want to do a dividend company, because you'd have to add in the value of dividends each and every year. Yeah, $50. You got it, Owen. If a company pays a big dividend, you would have to add that in as cash flow. I can talk about a book being in demand. Yeah, that's right. That's right, Paul. So, okay. Yeah. So Tarwin, good comments. There's two good comments here from Jason. What is the lowest theoretical price earnings ratio? And suggest you compare the lowest P ratio. Okay. So now we know this. I'm going to step back a minute and say there are a few inputs that we need to know. Obviously, we know we've made assessments about everything on the right-hand side. I'm going to do a dotted line, actually do a thick one. We know we've made assumptions about every single thing on that side of the line. And if we put this over there, then we know that that's also an assumption. And we know that this is also an assumption. And an assumptions make an ass of you and me if you get them wrong. So let's focus on how do we improve this, right? But first, let's talk about what it actually means to set these numbers right here, because this is an obvious mistake that a lot of investors make. There is no one right answer here, because no one knows for certain what the price earnings ratio will be in year 28. But we know for sure that most people seem to use the price earnings ratio a lot when they do valuations. Like they jump in here or they jump in Selfwealth and they go, okay, they go to the valuations tab and they go, oh, what's the price earnings ratio? Okay, yeah, great. 184. That seems pretty high. I won't buy it. When that could be wrong, because it could grow and the price earnings ratio could stay high, right? But no one knows for sure. Okay. So how do you pick this? Unfortunately, with Selfwealth, we don't have the capability to look back in time and see, well, what's the average, right? What's the average price earnings ratio? But what we can do with something like Ticker is we can look back in time, right? And then we can take the price earnings ratio average, which is this one right here, share price to the earnings per share, which is the thing that we're calculating. And this is the average. So we can see it went negative there. So I might cut it off from 2010. And now we can see the valuation over time. So this shows us that the average price to earnings ratio of this business is probably somewhere where about here, because we've got this big march higher over here where people have obviously finally figured out that, oh my God, AI is a thing, and they've started paying a very high price, or valuation, I should say. But the average is probably closer to this. It's probably closer to 40 or 30 or something like this. You can see for a long time there, it was actually in the teens. So to Tarwin's point, you might want to be on the conservative side of this. So say, for example, you set it as, because remember, 5 years is a long time. Remember, if you bought the stock in, say, 2018, and you were doing the exact model that we're doing, you would say 5 years from now, let's say it's around about 48, exactly what it is today. Well, then you found out 5 years ahead that it's 229 times. and you're like, wow, I didn't expect that. So you could see that that would be a mistake in underestimating it. But you can use the historical numbers to get a sense of what other investors are willing to pay. Another thing you can do is you can take a business, maybe not so much like this, but say, for example, you were comparing, I don't know, say you were comparing Levisa's valuation, seeing that we spoke about it before. So say, for example, you take Levisa and you get its price earnings ratio over time, like this. You can see it's like around about, say, 30 on average. And you could compare that to, say, a more established retailer. I'm just going to use JB Hi-Fi, the Australian electronics business. It's obviously not a direct comparison because one's selling jewelry and one's selling TVs. You don't put a TV around your neck. If you did, that would be very impressive. Don't try this at home. But you can see here that we could probably say, well, maybe in the long term, Levisa's valuation falls back to more normal levels. The valuation average for the ASX is around 16 times for the whole of the stock market. It's a price earnings ratio of 16. So we could say the same thing here. We could say longer term, Tesla's goes back to maybe say something like Ford. So let's quickly look at Ford. Ford F Motor Company. So it's going to be, I would imagine it's going to be, I haven't looked at this yet, but I imagine it's going to be really low because Ford is not a very impressive company. So we can see, yeah, well, okay. So we can see its price earnings ratio has recently gone to 20, then it went negative, and it's obviously skewed by this huge thing. So let's get that out of the way. So the price earnings ratio of Ford is like 10 at 10, 11, something like that, right? Let's take, what's another company? I don't think it goes. I don't know the ticker symbol for the correct ticker symbol for BMW. If someone knows, let me know. But let's say hypothetically, we believe that in 5 years, for some reason, Tesla's price earnings ratio is going to be like Ford. Now all of a sudden the valuation is 70. GM, yeah, good one. Thank you, Jason. I'll use that. So GM, Toyota. So I'll go General Motors first, and then we'll have a look at Toyota. I think Toyota will be in there. So just wait for this to load. 1 sec. It's crunching a lot of data. It's probably using NVIDIA graphics cards to calculate all this data, to be honest. Like somewhere on the line, there's probably an NVIDIA graphics card in there. So here we go. We've got GM's numbers. So we can see with GM, don't worry about these spikes, just mean that there was a big fundamental change in the business's profitability. But we can see the average is probably like 6. Does anyone know the ticker symbol for Toyota? Is that or is it TYT? I don't know which one it is. Let's go 723003. That could be it. BYD says Taiwan is around 34. So I saw a headline, Anthony says, that NVIDIA is a meme stock. Well, it's definitely in the meme category, but there may be a reason for that, right? Like I remember a lot of people saying that Tesla was a meme stock in 2012. It was about $40 a share, and then it's split 3 times or whatever it's done, and it's not that at all. So it's turned out to be one of the world's best companies. So we just need to be careful with that, is what I mean to say, Anthony, even if I agree with you, to be honest. So Toyota's is about 10 or 11. So if we believe that the valuation is going to come back to something like that, we can see what our downside probably is. However, typically the price earnings ratios of companies is set based on expectations. So if you think about it, if Tesla's still growing really fast, like this bit right here, in 5 years, it's unlikely that the price earnings ratio will be 10. It could happen. You could have a really fast growing company and then no one having money to invest, so you get a low price earnings ratio, but that's probably unlikely. I would say a more conservative estimate is probably more like 25 or 20 times. That's a conservative estimate, in my opinion. But is this conservative? So now we've talked about the price earnings ratio. Is this conservative up the top? So a way that we could change our model is, instead of saying, hey, what are analysts saying? What we could say is we can assume some numbers. So let's say we just put in 20% revenue growth, right? I don't like that formatting. Let's get rid of that. It's got that. And we say, hey, let's say last year's revenue, like this. So now we're saying the company grows at 20% per annum. Again, I get the yucky formatting, bit of OCD on my end. Sorry, guys. So now we can see that the company we estimate is going to grow at 20%. And let's do the same thing for profit margins. So let's put in our own profit margins. So let's say we'll start with 15%. And let's go like this, like this. And now let's do the same formula effectively. So sorry, not that. So we say that the profit that the company gets is equal to a 15% profit margin. So something like this. Let's drag that from left to right. And let's highlight these two things in our model as assumptions. So this and this. Now we can see, why is that not formatted? Come on, love. Okay, I don't know what I'm doing wrong there. Let's try this. Okay, it didn't work. Okay, that's meant to be, that's an assumption as well. Let's just put it in red because I can't figure out what I'm doing. Okay, so now we can say, okay, the company's going to grow at a certain pace, and if it's got a 25 price earnings ratio, I'll just remove those two really quick. We can see that it would have a valuation of $218. But now let's imagine it grows faster for the next few years, and then it starts to decline. Now, are there some analysts say that it should always fall by a quarter every year in your forecast? I don't believe any of that. I think that's why analysts aren't that good. Conditional formatting stuff. Thank you. Thank you. Let's get rid of that formatting. Let's just clear that for a sec. There we go. Thank you. Okay, so now we can see that if we've assumed our own growth rates and our own profit margins, they have said that they're going to invest more in cheaper type cars and try to bring down the price. So we could say, for example, that maybe the profit margin doesn't really grow and it maybe even declines a little bit. So say it declines into 13%, gives us an updated figure for the profit per share. But let's say the company also starts to buy back a few shares. So let's say instead of 3, 4, 5, 7, maybe after a fair bit it goes 3, 4, 5, 5, 3, 4, 4, 0, and it stays at that, right? Nominal impact, but it could impact the profit at the end of the day. So now we can see, and we'll put in some wild figures. Let's go 35. So now we can see a range of valuations, and this is how valuation should be conducted. It shouldn't be conducted as like, let's look at my finger and put my finger to the air and say, it's $240.42. You should have a range. You should know what your upside is and what your downside is. Now you could do this exact same thing for NVIDIA. So we could go through and do the exact same thing. We could look at competitors to determine this. We could look back in time. We can make an assessment about the future. There is actually a mathematical formula that determines what the price earnings ratio probably will be based on the profits and the growth of a company, and the interest rates at the time. So there is actually a model for this. So keep that in mind. But what we've done is, kind of simplistic. Tal, when you said just the price earnings ratio, the common multiple, but also price to sales, if not yet profitable, price to book for asset heavy businesses. Yeah, well done. Yeah. Earnings per share, you generally have to look up somewhere. Fair enough. Yep. So you can use this same model, to Tarwin's point. You can use this same model instead of using price earnings ratios. So instead of using PE ratios, or otherwise known as that, or otherwise known as this, you can use price to sales ratios, where you just divide the sales by the number of shares. But this is what I want to explain to you tonight, is now I've given you this model, you can just go and copy it. But this is like giving someone a hammer. It's a really good tool, but in the wrong hands, you can use it very wrong. And for example, the garbage in, garbage out methodology applies. If you come in and you go, I love Tesla, I think it's going to grow and take over the world, and then it's going to invest in Bitcoin and everything's going to be fine, right? And then all of a sudden you're like, wow, the valuation's $3,000. And why don't we put in a real price earnings ratio? Oh, it's $6,000 a share. I should put my whole portfolio in it. If you come in here and do that, you're going to lose out. And this is what I mean. Everyone can use this model, right? But the true work from being an investor, the difference between an analyst and an investor in my profession is that an investor knows how to use the tools. An analyst just chucks the stuff in there. And so your role now, if you are interested in Tesla, should be determining, well, do I think it can get to $250 billion of sales when Ford, let's have a quick look at Ford. When Ford is achieving, let's have a look at financials, when the entire Ford business is currently achieving $150 billion. Do I think that Tesla, in just a matter of 4 or 5 years, can be bigger than all of Ford? And then you would say, okay, we know that Tesla's producing 440,000 cars every quarter. Number of Toyotas produced every year. When we know Toyota says it's aiming to produce 10.6 million in a year, so Tesla's on about 1.4 million. So does that make sense? Does it make sense that Tesla could do that? And if you believe that, yes, I believe Tesla could do that, well, maybe this is what you would want to look at. Another thing when you look at the profit margins is you want to look at what kind of products will they be selling in the future. We know that Tesla's going to sell a cheaper model of Tesla. The current models are around $60,000 to $80,000 in Australia, or up to 100, but 60 to 80,000. They want to bring that down to probably, in my opinion, they'd probably be below or at $50,000, which means they're going to have to take a hit on either their costs or their margins. And then they're probably going to do a buyback, or they might start paying dividends. Another final thing that this doesn't tell you, it doesn't tell you if the company that you're looking at is a good company. You have to go back and you have to look at the checklist. You'll have to look at doing the research. You'll have to look on the balance sheet. One thing that this model doesn't capture is it doesn't tell you, does the company have debt? How much debt does the company have? How much cash does it have? You still need to do all of these things. So I just want to insert this as a warning, but you can do this. So the question before, I can't remember who asked it. The question before was about Square or Block. That company, you can do exactly the same thing. Francisco, you asked a question earlier on. Sorry, I didn't get to it 6 minutes ago. You said, is earnings ratio what financial news are referring to when they say multiple? When they refer to earnings, does that mean profit per share? Yes, exactly, Francis. Pardon me. And when they say multiple, they mean price earnings ratio. However, sometimes analysts can define it again, and they can say the sales multiple. So I think it was Tarwin before was saying, sometimes you can use the price to sales ratio or price to sales multiple. We call it a ratio, but most people know it as a multiple. Like that's how we should refer to price to earnings ratio. It should be price to earnings multiple, because it's like a multiple of earnings, right? It's not a ratio unless you do it the other way. So Anthony was Square. Yeah, so you could do the same thing for Square, Anthony, using that type of spreadsheet. You just get the growth that you assume, and then you apply a multiple to that. Why don't we see if we can do that in record time? Okay, so let's just take our super quick model, just like this. We'll dump it here, and we'll go, if I can write it, we'll go Square/Block, right? Now, I'm not going to worry about any other gibberish. I'm just going to go straight to the 2028 year. Now, we'll use a ticker to do it. SQ is the ticker symbol. So we'll bring this up. We'll go estimates. That's where the analyst things are found. So we click on this. We go to, okay, they've got 2027. We'll assume that that's 2028. 35 billion. So we'll take that. We'll chuck that in here. Let's get rid of all this other stuff because I really don't want that in there. Then we'll come back into it. And now we'll look at, so the net income or the net profit. I don't think they have another form of net profit in here. No, so we'll take that. We'll chuck that in here. So you can see that they're assuming a 10% profit margin in the future. We'll find the number of shares that are available. So we'll go back in here, and the number of shares is not shown here. We'll jump into Selfwealth and get that. So we go SQ, Block, we go financials, we go down and we find the number of shares outstanding. We'll say 578, but we can see in the years gone by, like when they bought Afterpay and all that, they had to spend a lot. So 578 million. So we'll just chuck that down in here. And we can see that the estimate of earnings per share in the future is $6.10. This might not be 28.28, by the way. I don't know the financial years for block/square, so we'll get rid of that. And we can see here that if we apply just a very simple price earnings ratio of, say, 30 to that, we've got a price earnings ratio in the future, pretty simple, $6.10. It gives us a share price of $571. Now, I don't know what the share price is of SQ. Okay, we don't have it. Why did that not come up? It's not on that exchange. It's on this exchange. $71. So obviously something's gone wrong in our model here. But that looks a bit wild. So I want to just double check that. Let's have a quick look at earnings per share. I don't think it's profitable, so I don't know if this would actually work. No, it's not actually profitable. Let's see what Square's saying for earnings per share. Ticker's saying. So here we can see that, yeah, it's normalized, yeah. So then if you applied like a 20 times price earnings ratio on that, you're going to get a very aggressive price earnings ratio, very aggressive valuation. And at the end of the day, this is where the shortcomings of this model come in, because you don't know between now and 2027 if Block will actually do what it's supposed to do, right? It's a much more sensitive business. And so I wouldn't be as keen on looking at a business like this and using a price earnings ratio. So I'll quickly show something. We'll wrap up. When we've spoken about it on the show before, but when you have a company and an industry, you typically have something called an S curve. And this is a chart that looks, say, something like that, right? And basically what this shows is it plots like the growth or the innovation of a business over time. And at certain times in that industry or in that business, you use different models. So when a company is very early days down here, I'll just change my color to something brighter. It is typically not profitable. So the price earnings ratio does not work. So you might need to use the price to sales ratio. So where you compare the price to the sales. In here, you might start to use, you probably wouldn't use the price earnings ratio, probably go still like this. Up here, you'd start to use the price earnings ratio or dividend yield. And then over here, you've basically got the dividend yield. So up here, you'd have a company like, say, CBA or Woolworths. You could probably value that with the dividend yield. In here, you'd probably have a company like ARB or Tesla or something like that, where it's profitable and it's quite a mature business, and you can use that. In the early days, you might use something like Zero is probably like right here for its valuation. Tesla's probably like right here. Woolworths is like right at the top. And down here, this is more like venture capital. And, it's crazy, and I'll finish with this, but when people invest in small new ideas and new companies, typically they don't even do a valuation. They just look at the idea and they look at the people and they go, okay, I'll invest. That's really it. There's no really valuation, because at that stage you don't really have anything to go on. So anyway, so we've got a few more things to tidy off before the end of the show. Thank you for being with me tonight. We're just going to go through upcoming shows. So next week I'll be sharing 5 dividend stocks with you. Some of my five of my favorite, we'll get into those. The third show, some of you did suggest last week that we should cover FIRE, the financial independence movement. Do you still want us to cover that? Would you like us to dive into that? Because I definitely can. If you do, let us know. Otherwise, please comment in the chat now what you want us to cover in that third week, because this is kind of like a great week for us to explore something. Do more on valuation, says Francis. Yeah, we could do more, definitely. We'll do more over time. So we'll do more valuation work in there. And then we've got the tax return one, and then we'll be joined by Beta Shares for a 4-part series, which will be awesome. That's in August. So I'm excited for that. And there's actually special news for this one too. I can't tell you, but it's going to be exciting. So stay tuned for that. Okay, so I think that's yes, please, for $5,000 tax return. Yeah, Leonie, so that will be in the 4th week. So we'll be covering all of these things over the next month. But we will cover, so everyone's saying, oh yeah, Paul, that was right, passive income. I'm going to write that down, passive income. And we could probably do that next week. We could probably tie that in with our session on dividend stocks. That says passive income. Somewhere in there, there's a C, an O, and an M. And that thing on the end is an E. So, yeah, I may have gone to business school, but I didn't go to drawing school, unfortunately. Yeah, so Anthony, final comment. You've said, I feel these stocks are better off inside an ETF. That's why we have the ETFs, and they're fantastic for that. You don't have to go and buy these individual stocks. You don't have to. Simple as that. An ETF is fine for most people. And when I say you, I'm saying like people in general, right? General advice only, general advice warning. But yeah, that's what a lot of people end up doing is they just use ETFs because it's simpler. It's more diversified. Not to mention the tax implications, Paul. Yeah, right. So looks like we're going to cover passive income next week when we do. See that we've got the fire. We'll do a bit of a section on fire. Thank you everyone for joining us. General advice every time, says Rob and I. Remember that big disclaimer at the start there. I use the word you a lot, but I just mean like you as an investor. So thank you, everyone. Thanks, Shell. We'll be back next week, same time. If you don't receive an email, you know where to come. Wednesday afternoon, head to the Selfwealth YouTube channel, and it will be waiting right there, staring you in the face. It will say passive income or forget CBA. And it'll have a cheeky headline, no doubt. So thanks Benny. Thanks, Owen and Rob. Was a great general advice show tonight. It was indeed. Thank you. Thank you. If I do say so myself, Benny, see what you did there. Thanks, guys. I'll see you soon. See you on the other side, maybe with a different haircut. And Rob and I really thank you for coming along tonight. And tell your friends. We'll be back next week. Thanks, guys.